Hi, everyone. This is Zach Gast with CFRA.
Hi, and I'm Nick Elliott, also with CFRA.
What we wanted to do today was spend a few minutes to talk to you about what we're seeing in early results from the new current expected credit loss model, which was introduced for the first time this quarter. So with that, I'll kick it over to Nick, who has a few initial thoughts.
Yes. So we had the big banks reporting. It's a first chance to get a look at this. This is a big change, probably the biggest accounting change in decades, just in case the quarter couldn't be any more confusing for us. So that's why we're going to try and break this down. We're talking CECL. That stands for Current Expected Credit Loss. And the big difference there is the E, the expectation. What we had before was called an incurred loss model. What the difference is that instead of waiting for a loan to go bad, they're going to have to reserve for all their loans through the cycle. So basically what they did on January 1st is they looked at their entire loan book and they said, okay, what's going to happen over the next 2 years and how many losses can we reasonably expect? Whereas before they would have to actually wait for something to go bad. The other big difference between this and the prior methodology is that we have macroeconomic implications here. They're going to be using models to kind of forecast that in. Before you had a little bit of like a qualitative factor, but now those economic expectations become much more important. And what's quite a quarter to start it off because we do have a very big change in macroeconomic estimates. So I want to talk a little bit about what happened on January 1st, just from the switch from the old accounting to the new accounting. Basically, what we saw is that a lot of these allowance increases were in line with the prior guidance. Because you are reserving for things that haven't gone bad yet, we do saw that the allowances went up. In most cases, that was between 25 and 55%. I would expect that once some of these other consumer names, especially some of the credit cards, start reporting, they might be even a little bit higher than that. But there's a couple big differences between how these different banks are reporting. The biggest issue is just basically your loan distribution, what kind of loans you're originating. Because the two factors that go into this are the life of the loan and your historical net charge-offs, right? So basically, if you have a longer life, that means that you're going to have to reserve more because there's more of a chance it's going to get charged off. And then obviously, if you have a higher loss content, then you're going to have to reserve higher for that. So in practice, what that means is that really your consumer loans have seen the highest. Credit card, obviously, anything that's unsecured is really getting pushed up a lot. Real estate is a little bit of a mixed bag. Obviously, you have a very long loan maturities on those. The average life of a mortgage, even if it's 30 years, about 7.5 years. But of course, since the crisis, we've seen very low losses on those. So you have that kind of counterbalancing factor. The one area where you're seeing a little bit less reserves in a lot of cases is actually in the commercial side. And the reason for that is that there is a interesting tweak in CECL. You're only allowed to model your losses up to the contractual life of that. And because a lot of these commercial lines are warehouse lines or things that re-up after a year or even as short as a quarter, they don't model that past that contractual life. So in fact, when you look at Wells Fargo, in their day one impacts, they were actually a negative 1.4 billion hit to their allowance because of the shorter length of that commercial portfolio, which makes up about 40% of their loans. On the higher end of that, you've got U.S. Bancorp and Citigroup, and that's driven mostly by their credit card portfolios. But obviously, there's a very big difference between what they were modeling on January 1st versus March 31st. In case you haven't heard, it's a bit of a pandemic going around. So, Zach, what do you think about the Q1 provisions?
Well, before I talk about the Q1 provisions, I think it's important to first talk a little bit about what happened with Congress. Because for the first time, we had a move by Congress to actually amend accounting standards. And what they did was they passed, as part of the CARES Act, a rule that said that regulated banks could not apply CECL accounting until the end of the emergency or December 2020, whichever came first. And the rationale behind that was they were concerned that the increased expense would reduce the capital of the banks and suppress lending in the real economy. Now, my personal view is that accounting reveals financial information. And when you change the information because you don't like the effect on regulated entities, that's probably a bit misplaced. In fact, regulators within days of the CARES Act being passed put out new regulation that simply said you can delay the effect of CECL accounting on your capital adequacy, which is definitely the better way to handle the issue. The regulators can always take the information they have and make changes to the way they apply it. This isn't the first time regulators have done that. If people think back to FAS 158, which was the new pension accounting rules years ago, 10 or 15 years ago, the regulators did the same thing. They said, look, we're going to take some time and let this play out. What's interesting is that when we started looking at the banks, almost none of them took that exemption because the worst impact, the one to capital, has been delayed. And most seem to take that option to delay it. We actually only found one small bank, Century Bank in Massachusetts, that took the exemption and didn't apply the new CECL standard. From a bank perspective, it simply didn't make sense to roll back all the systems you spent years developing if you only had 6 or 12 months of relief. So it's good to see that almost everyone, excluding some of the market cap, small market cap banks, is actually going to apply the CECL rules. So we're looking at banks, financial companies on a consistent basis. On to the quarter itself. So what I would say is that the quarter definitely showed the effect of marking the entire loan book to lifetime credit losses for the first time. We did that during a global pandemic that's seen GDP contract significantly in most countries. And I guess if you're going to jump in the deep end of the pool, it doesn't matter how deep the water is, and this is the environment we're in. So I think in looking at the banks, what came across was that loan provisions were up significantly. And this should surprise no one. If you look at the stock price of the banks, everyone was expecting this. But the world didn't end. JP Morgan's loan loss provision for Q1 of 2020 was significantly greater than its loan loss provisions for all of 2019. But not a single financial company in our initial survey swung to a loss. That's significant. Companies did a really good job of walking investors through the moving parts of CECL. I would highlight Bank of America in particular, which had a great consolidated slide in their investor presentation that showed reserves by loan type. So you had some disaggregated information. And they did that presentation of reserves for December 31st, 2019, January 1st, so showing the initial adoption, and then at March 31st. So you essentially had all the pieces right there up front that everyone could use. It was a great disclosure, and the bigger banks do tend to have better disclosures, partly because they put out these huge supplements that people really rely on. I don't want to just highlight Bank of America. I think JP Morgan, Key Bank was another bank we looked at where their supplements had really good granular disclosures at the segment level. So those were great. I think one other bank I would highlight in terms of what took place was First Republic, because they were actually explicit in explaining to people, here's our provision in Q1 applying CECL, but here's what it would have been. And the actual provision during the quarter was $62 million, which is fairly low for a bank of First Republic size, but they mostly have a mortgage portfolio. But then they also came out and said, look, even without CECL, our provision would have been $40 million. So it was higher, but it still would have been much higher than it was in previous years. So it's important to remember that CECL did cause some increase in the loan loss provisioning, but the global pandemic would have caused an increase anyway. And so that's the provision piece of the puzzle. That's the income statement. But forensic analysts, it's our job to also look at reserves, take a look at the balance sheet. And so we want to do that as well. And let me caveat the heck out of this by saying that the banks are running really sophisticated financial models with lots of moving pieces here. We don't have visibility into all of the pieces, but our job as analysts is to take a look at the assumptions we know about and say, do we think these reserves are adequate at this level? And I think our emerging consensus at CFRA is that we think there's significantly more provisions to come. To get there, we relied on a few key inputs. First, we looked at the economic indicators that parallel different types of losses. So credit cards tend to track closely with unemployment, for example. Commercial loans tend to track lower grade credit spreads in the bond market. And all those indicators suggest that unless we see a quick reversal of economic trends, losses on these types of loans could be worse than the financial crisis. So the way it plays out is really going to matter, but right now it does not look good. In contrast, what we're seeing is reserves that range from just over 1.1% on total loan portfolios to up to 3%. And the banks on the high end tend to have larger consumer portfolios, while those on the lower end tend to have more commercial and commercial real estate loans. Those reserve levels suggest that losses will be significantly less than they were during the financial crisis. And just to put that in perspective, during the crisis, we saw credit card losses that for 6 quarters were above 8.5%. But when we take a look at all the banks where we have information on reserves against credit card portfolios, not all the banks provided that. Some of them rolled it up into certain segments rather than doing it loan type by loan type. We didn't see anything above 8.25. And if you think back to the unemployment rate, that's a good indicator of credit card losses. We are at a higher unemployment rate right now, according to most economists that are looking at real-time data, than we had during the great financial crisis. And so you would think that that would track higher. So again, it's all going to depend on how long this lasts. The commercial loans and commercial real estate are two other areas where reserves don't seem to be keeping up with the deterioration we're seeing in the real economy. Reserves there are sitting at 1 to 1.5% in general across the big banks. And CRA loss modeling suggests lower losses based on LTVs, but we're going to see real pressure on those values in the loan to value because we are seeing tenants default on their leases. We all know about the stress that's going on for retail stores, for restaurants. All that plays out in commercial real estate portfolios and will play out in not only net operating income declines, but also on cap rates as that goes forward. So what we want to do is think about how the banks got to these reserve levels. We talked about this earlier, what the big drivers were of those, but the first thing that stood out to us was the economic models that were being used. Some of the banks used internal models, and a number of them also used external models or simply used external models. And listening to the conference calls, Moody's was the most mentioned model on the calls that we listened to. What became clear from listening to the executives that discussed how they were thinking about it and how they were modeling it was that the model specifically pointed to a hard V-shaped recovery. I'm not an economist. It's not my place to argue with the forecasts that were used, but investors should keep in mind that as evidence emerges that we're either over or underperforming that assumption, which is underpinning the reserve models, loan loss provisions will either continue to go up or they'll reverse depending on the direction. So I think it's going to be really important to keep in mind what we think the forecast is and whether we're deteriorating more than that or less than that. I think a second real point of interest is that we've got an exercise performed each year that we can compare the current environment to. And several of the banks actually got questions on this and addressed it directly on their calls. Nick, I don't know if you want to talk about that.
Yeah, so the questions were on the DFAST modeling, and these are the stress tests that the Federal Reserve put the banks through. And the idea here is basically to make sure they have enough capital in a severely adverse scenario. So in the eyes of the Fed, a severely adverse scenario is 10% unemployment, a 10% hit to real GDP, and investment-grade credit spreads blowing out to about 7%. And that is going to be over a period of about 9 quarters. What's interesting is that for the biggest banks, they make all this information public. And so, you look at what these guys are reporting, JP Morgan said that they were going to lose about 60 billion. And their reserves today are only about 23 billion. Wells Fargo said they're going to lose 44 billion in that scenario versus their current reserves of only 11 billion. Same thing with Bank of America and Citigroup. What we're seeing is that the reserves right now are really only about a third to a half of what they were going to project, what they submitted to the Fed. So, a reasonable question to ask here is, well, wait a minute. If the entire idea of CECL is you're modeling this through the economic cycle over the lifetime of the loans, why is this, so much less than what you said it was going to be when you talk to the Fed? And I think the answer to that comes from a couple places. The first part is that the CEOs pointed to was that this fiscal response that we've had from the federal government in terms of these $1,200 stimulus checks and not to mention all the monetary stimulus coming from the Fed from all the asset purchases and the payment protection program to protect small businesses. That was not modeled in. So that is one sort of fig leaf that they're using to say, hey, you know, we don't think it's going to be bad as we projected. Another thing that they said, you know, as you mentioned, Zach, they're really expecting closer to a V-shaped recovery than what the models for the scenarios would suggest. In that scenario, this recession is dragged out in the simulation from the Fed over a course of 9 quarters. So, you know, just over 2 years versus, you know, a lot of these banks are thinking that we could get back to normal a lot sooner than that. And the other thing we've seen is that from the economic side is that it's not necessarily the depth of the recession, but the length of the recession. And so if they're modeling in that that recession isn't going to be as long as what the, you know, the Fed projection for, you know, the stress test was going to be, then that's why they can say that their reserves are going to be lower. The, you know, one issue about this, though, is that all of that is based on information as of March 31st. The big payroll data that came out was after that, when exceeding expectations for initial jobless claims. So we should see those economic models start to turn downward. And you know, the CEO for Wells Fargo was pretty explicit about this. And you know, I think his quote was, "I think it's fair to say, at least in my mind, there's more downside than there is upside at this point, just given the uncertainty of the environment today." So, you know, obviously they're supposed to model it all the way through, but I think that there's definitely a chance that we're going to see continued provisions for the next couple of quarters.
Yeah, I think it's interesting, and we will find out more. It's important to keep in mind we've only got 4 or 5 days of reporting behind us, and it skews heavily to the big banks. So large consumer credit card portfolios and then commercial lines. What we have coming up is more of the specialty finance lenders, some of the regional banks where we're going to see far more commercial real estate, some C&I exposures. And then on the specialty finance side, you get some of the really esoteric ones. So it'll be interesting to see how that plays out through the rest of this earnings season. That being said, I hope this was useful as you start to look out to the rest of earnings. We appreciate everyone listening in and look forward to speaking again soon. Thanks.